Hello and welcome back to the course. A massive fatal mistake that unfortunately is far too common in the Forex world is using too much leverage. And leverage works both ways. So if you are to, say, risk 20% of your account and you get the market turned around against you and you end up losing, to make that 20% back, you actually, the next time, you need to make a 25% gain from where you're starting. It's not a one-to-one ratio. Most people don't think about that. They think about the money that they can make instead of the potential losses. Compound interest works in both directions and is quite unforgiving. One of the most important things in the compound interest equation is going to be time. And time is something that you need to have play out, as well as the better than usual returns that you can get in the Forex market. In front of you, I have a euro dollar daily chart. And the reason I have this is there's been a highly publicized, at the time of recording, head and shoulders in the euro dollar pattern or chart. And this pattern, as you can see, is 400 pips, and a neckline at 117 should send the market down to 113. And you can even make an argument for it makes sense considering their support there. Now, as I record this, you can see that we are testing the 1.17 level, the neckline, for the second time. And that brings up an interesting problem. If you are a short seller of this market and you are highly levered, if the market breaks above the 1.17 level, you are going to be very uncomfortable in a very quick manner. True, had the market moved in their direction immediately and they dropped to 1.13, they would feel like geniuses. But as we are testing this for a second time, one has to think that things could get very interesting very soon. And if we break out to the upside, those losses are, I suspect, going to wipe out quite a bit of retail traders around the world. Would not want to be highly levered in this trade, because if you had your stop loss here and it's a 1% loss, it's a 1% loss and you're not happy. But at the end of the day, it was about twice as, maybe even a little bit more than twice as far down. So it would have been a 2.5% gain. You had a 1% loss. Now, on the other hand, if this is 20% of your account, again, once you get blown out, you need to make 25% back just to get to break even. I cannot stress this enough. Over leverage is why brokerages almost always come out on top.